Inflation in the United States is usually explained through familiar headlines: wages rising too fast, energy shocks, interest rates staying high for too long. Those explanations are convenient but incomplete. They focus on what consumers see, not on what factories absorb, long before prices ever reach a shelf. Manufacturing inflation does not begin at the checkout counter. It begins with inputs. And among all industrial inputs, aluminum is one of the most decisive and least discussed. Aluminum sits inside almost every physical layer of the U.S. economy. It is in cars and trucks, aircraft frames, construction materials, power transmission systems, food and beverage packaging, and consumer electronics. It is not optional. When aluminum costs change, producers cannot simply redesign around it. They must pay the price. This is what makes aluminum dangerous from a policy perspective. Its cost increases do not arrive as a shock. They diffuse quietly through supply chains. A few percentage points here in automotive components, a slightly higher cost there in packaging, construction, or electrical equipment. No single price spike looks dramatic enough to trigger alarm, yet taken together, they steadily compress margins across manufacturing. That pressure does not immediately show up in headline inflation data. Companies absorb it first. They delay price increases. They cut investment. They slow hiring. By the time consumer prices finally rise, the damage has already been done upstream. This is why aluminum matters. It is not a political commodity. It does not attract loud lobbying or public debate, but it functions as a cost multiplier across the real economy. When aluminum becomes unstable or expensive, inflation does not explode, it spreads. And that spread is far harder to reverse. The central vulnerability is not that the United States lacks aluminum production. It is that the United States lacks aluminum production that is simultaneously low cost, stable, and scalable over time. Primary aluminum smelting is one of the most energy-intensive industrial processes in existence. Profitability depends almost entirely on electricity prices and long-term energy stability. Without cheap, predictable power, aluminum becomes structurally expensive, regardless of labor or technology. In the U.S., that reality collides with three constraints. First, electricity costs are higher and more volatile, particularly for heavy industry. Second, aluminum smelting relies heavily on fossil fuel-based energy, exposing producers to fuel price swings and regulatory pressure. Third, restarting or expanding smelting capacity is not a short-term project. These facilities require massive capital investment and decades-long planning horizons. This means aluminum cannot be reshored quickly in response to policy incentives. There is no rapid domestic substitute that can replace large volumes of low-cost aluminum without raising prices across manufacturing. As a result, American manufacturers operate with a structural exposure. They depend on aluminum that meets a very narrow set of conditions: consistent quality, predictable pricing, and long-term supply security. When those conditions hold, production remains competitive. When they do not, costs rise everywhere at once. This is not a hypothetical weakness. It is a physical and economic constraint embedded in the industrial system. Ignoring it does not remove the dependency. It only delays recognition of the consequences.
The United States does not lack aluminum. It lacks insulation from aluminum-driven cost inflation, and that distinction defines everything that follows. At this point, the analysis stops being theoretical. The U.S. manufacturing system already relies on an external anchor for aluminum stability, and that anchor is Canada. This is not a matter of trade preference or diplomatic goodwill. It is a matter of industrial physics. The majority of aluminum that truly works for U.S. manufacturing, meaning aluminum that is cost-stable, energy-efficient, and reliably delivered at scale, comes from Canada, with the center of gravity in Quebec. The reason is neither ideology nor subsidy. It is energy structure. Quebec's aluminum industry is built on abundant hydroelectric power. That single fact changes everything. Hydropower provides electricity that is not only cheaper than fossil-based alternatives, but also far more predictable over long time horizons. Aluminum smelters do not care about quarterly volatility. They care about uninterrupted power, day and night, year after year. Quebec offers exactly that. As a result, Canadian aluminum enters U.S. supply chains with a cost profile that American producers cannot easily replicate. It is cleaner, yes, but more importantly, it is steadier. There are fewer fuel shocks, fewer regulatory whiplashes, fewer pricing spikes that ripple unpredictably through contracts. This stability is what allows U.S. manufacturers to plan. Automakers, aerospace firms, construction suppliers, and electrical equipment producers build long-term cost assumptions around aluminum. When those assumptions hold, investment decisions make sense. When they do not, projects stall or quietly become unviable. It is critical to understand what this relationship is not. Canada is not acting as a discretionary supplier that can be swapped out with minimal friction. There is no equivalent pool of low-cost, hydro-powered aluminum capacity waiting elsewhere. Replacing Canadian aluminum would mean accepting higher energy costs, greater volatility, or both. In practical terms, Canada does not simply supply aluminum to the United States, it supplies predictability. And predictability in heavy industry is worth more than marginal price differences. That is the condition Washington must confront. Aluminum flows from Canada not because of habit, but because the industrial system has evolved around it. Disrupting that flow does not create leverage, it removes a stabilizer. The danger begins when policy treats aluminum like a normal trade variable. It is not. Aluminum behaves less like a commodity and more like infrastructure. Small disturbances do not produce visible shocks, they produce widespread cost seepage. Disruption does not require tariffs or dramatic announcements. Even signaling instability, through threats, reviews, or politicized uncertainty, can be enough to raise prices. Aluminum markets price risk early. Manufacturers feel it immediately. The sequence is consistent and unforgiving. Aluminum costs rise at the input level first. Producers cannot substitute away from it. They cannot pause production. Instead, they absorb the increase. Margins tighten. Capital spending slows. Hiring plans are revised downward. None of this appears in inflation data. Only later do companies begin to pass costs forward. Even then, the increase is fragmented. Slightly higher vehicle prices here, marginally more expensive appliances there, incremental increases in construction and packaging costs. No single category spikes enough to attract attention.
This is why aluminum-driven inflation is politically deceptive. It spreads horizontally across sectors rather than vertically within one. By the time consumer price indices respond, manufacturing profitability has already been eroded. At that stage, policy responses are mistimed. Interest rates can be raised, but higher rates do not lower aluminum input costs. Subsidies can be proposed, but they take years to materialize. The inflation has already been embedded into the cost base. This is the core risk of destabilizing aluminum. It does not trigger an immediate crisis that forces recalibration. It initiates a slow compression of industrial competitiveness. Factories do not close overnight. They simply become less efficient, less investable, and less resilient. From a macroeconomic standpoint, this is worse than a visible shock. It is harder to diagnose, harder to reverse, and easier to misattribute. Aluminum does not punish policy mistakes loudly. It punishes them quietly, through sustained manufacturing inflation that accumulates long before it is officially recognized. This is where the strategic contradiction becomes unavoidable. Washington is accustomed to treating trade relationships as instruments of pressure. Tariffs, quotas, reviews, and leverage are familiar tools. They work when alternatives exist and when disruption imposes asymmetric pain on the other side. Aluminum does not fit that model. In aluminum, the United States is not exercising leverage over a supplier. It is managing exposure to cost instability within its own industrial base. The relationship is not political first, it is structural first, and structure does not respond to pressure the way politics does. What makes this paradox dangerous is that Washington does not need to act aggressively to create damage. Uncertainty alone is enough. When aluminum supply becomes less predictable, whether through trade rhetoric, regulatory friction, or strategic ambiguity, manufacturers immediately price in risk. Contracts adjust, hedging costs rise, capital decisions slow. Canada does not need to retaliate for this effect to occur. It does not need to use aluminum as a weapon. The mere possibility of instability increases costs inside the U.S. system. In this sense, leverage operates in reverse. The side that requires predictability is the side that pays first. This is why traditional toughness fails here. Pressure assumes that disruption is a controllable instrument. In aluminum, disruption is self-inflicted. The United States cannot credibly threaten a supply relationship that functions as a cost anchor for its own manufacturing sector. The paradox is simple and unforgiving. The more Washington signals unpredictability, the more it destabilizes the very input that keeps U.S. industrial inflation contained. Strength, in this case, is not about forcing outcomes. It is about preserving conditions.
Aluminum exposes a limit to pressure-based thinking. Some systems do not bend under force. They only become more expensive to operate. When the analysis is stripped of politics, one conclusion remains. Canadian aluminum is not a supplementary input to U.S. manufacturing. It is a shock absorber embedded deep within the cost structure of the American economy. It dampens volatility. It smooths energy-driven price swings. It allows manufacturers to plan years ahead with confidence that their most energy-intensive material will not suddenly become a liability. Without that buffer, inflation does not need a crisis to emerge. It accumulates quietly through higher production costs. This is why aluminum matters more than its visibility suggests. It does not move markets dramatically. It stabilizes them continuously. And stability, once removed, is not easily restored. If Washington undermines this relationship, intentionally or accidentally, the result will not be a dramatic rupture. It will be something more corrosive. Persistent manufacturing inflation, weaker investment incentives, and declining industrial competitiveness that is difficult to trace back to a single decision. Aluminum is only the first layer. Energy, fertilizer, and electricity operate under similar logic. They are not political levers, they are economic foundations. Treating them as tools of pressure confuses power with control. The lesson is straightforward. Inflation is not always the result of excess demand or loose monetary policy. Sometimes it is the price paid for ignoring the quiet systems that keep costs from spiraling in the first place. In aluminum, the United States is not managing a trade relationship. It is managing its own margin for error.